Welcome back. You're watching Markets at Noon on ET Now. We have the management of Gulf Oil Lubricants India. We have the MD and CEO Ravi Chawla joining us. Good afternoon, Mr. Chawla. And before we kickstart our discussion, let me wish you, your family, and the entire team at Gulf Oil Lubricants a very happy Diwali and a prosperous New Year. Uh, let's get going with the discussion on your earnings and also the way forward for your company. So we've seen the crude oil prices actually inching up. How do you exactly see this actually impacting your margins in times ahead? Could you give us some guidance on the margin front? Also, if there are any other challenges that you see that could that would you actually foresee for your company and industry going ahead?
Thank you for your wishes and wish all of you also the same and all the viewers. Quarter two has been a record revenue for us. Our margins have bounced back to the levels which we wanted to be. Of course, like to like basis, it is 16 to 18% band we work on. It's 14 and a half for last quarter, but we are like to like we would be at 16 because the raw material cost for us have been going up for the last few quarters as we have shared with you. That has happened because of base oils, which are the ingredients we have. They do follow the crude trend, but they went up significantly. And now we have had enough pricing actions, which are now helping us to recoup the margin. And I think you have seen crude also is there, but we are hoping that base oils will be steady now. And of course, other input costs have gone up. So I would say that the demand conditions have really improved in quarter two after we had the coming back from the close down in quarter one of the retail markets. Our B2C, B2B ratio has gone back to 60/40. So I think the crude increase, of course, there is crude going, but it is steady. And we hope that, base oils also remain steady, which are a derivative of crude. It has a lag time, different sometimes demand supply of base oil is slightly different. And we are hoping that the margins will go back to the 16, 18%. And the direction is very clear. Demand conditions are stable and margins are moving up.
Sure, Mr. Chawla. This is Vinny as well joining in on the other side. I just want to talk a bit about the demand trends. How are you seeing the demand trends both in rural and urban areas recently? Could you highlight the trends visible in different segments and offerings for you?
Last year quarter two there was a pent up demand, because agriculture was doing very well last year. If you take the same quarter, this year is slightly different the way the quarter two has played out for us. And if you take the recent demand shoots that are there, we are seeing very good stable demand across the diesel engine oil segments. Agriculture was not as buoyant as last year, but still the demand is steady. We're hoping that with the season coming in, agriculture will go up. Motorcycle and car has also picked up because urban centers, cities are open. Rural, which actually boomed last year because the COVID impact was less, is slightly subdued, but everywhere it is positive. And what is really working is the industrial and the B2B segment, which is 40% of our business is what we call B2B. And that has really been steady demand with manufacturing and other infrastructure customers also picking up normal. And I think that stable demand is a good pointer. I think we would be better, if the agricultural demand also picks up with the season. So stable conditions all round. And the factory fill business for us is only 5% of our volumes, which goes to the new vehicles. That again will start picking up now. And that has probably been one of the areas which has been under some pressure, but now will pick up.
Mr. Chawla, let's talk about the EV. How is your company actually adapting to the EV environment? What is the strategy on that particular front? And how do you foresee the India demand trajectory for these products? Can we also see you setting up some electric charging station in India?
Well, yeah, it's an area where obviously a lot is happening, both globally and India. Also, we are seeing a lot of traction, and on the ground level, of course, there is the EV adoption process in various segments is underway, and what we have from the lubricant consumption point of view, whatever the penetration in India is the third largest lubricant market. We are still going to grow 2 to 3% in volume overall as an industry the next 10 to 15 years in terms of lubricant consumption. Different segments are there: diesel engine oil, industrial, the motorcycle, car. But the impact that we see will obviously be that some of the electric vehicles will not have engine oils as you go forward and the penetration goes up. We are globally looking at the areas of the EV value chain. We have made an investment globally through our parent company, Gulf Oil International, in a charging company called Indra Renewables, which is into home charging in UK. The Indian entity, Golil, also has put an investment into this. So we are doing a pilot for car chargers, the Indra chargers in India. And we are looking at the EV value chain where we can look at some of the areas you mentioned. So work is on there. And if we do see an opportunity, we will obviously put up the proposal to the board and surely share it with all of you. But EV space is going to evolve. At the moment, we don't see the demand for lubricants coming down in the next 10 to 15 years at least. So, but still, we need to make our moves in the EV value chain, which we are currently working quite, in many ways in that. And hopefully, we'll see some movement from us in the EV value chain soon.
Right, Mr. Chawla, we are surely going to keep an eye out on your updates coming in on the EV space going forward as well. But as of now, you could tell me the current split between the B2B and the B2C segment, and what is your target mix going forward currently?
Well, you see, we have a mix. The current mix is a channel mix, which is 60% in the quarter two. In fact, we did, which is B2C, which is basically selling lubricants through our distributors to the retail replacement market and through the OEM tie-ups for the franchisee workshops. This is about 60%. The balance 40% is through our supplies through industries, infrastructure customers, to OEMs directly for their factory fill. So 60-40 is the current mix, and we are growing as a company. We've been growing 2 to 3 times the industry for the last over the last decade, and we continue looking at growth in both these segments, which are B2C and B2B, because for us it is a market share gain which we focus on with our strategies, and both these segments are important, and we will continue to do focusing on our brand and our tie-ups and other technical product features, which will help us to increase market share in both these segments.
Okay, Mr. Chawla, thank you so much for joining in with us on ET Now. It's a pleasure having you on the show.